The market is currently closed, and we are looking at the final numbers from the session on Friday, November 28, 2025. Beyond Meat Inc., ticker symbol BYND, closed the trading day at $1.02 per share, down approximately 3.75% on the day. In the after-hours markets, we have seen it drift slightly lower, hovering just under the $1 psychological support level at roughly 98 cents. Seeing a stock that once traded above $230 now fighting to stay above a single dollar bill is a sobering reality check, but the numbers on the screen only tell a fraction of the story. Most investors look at that $1 price tag and assume one of two things. Either the company is on the immediate brink of Chapter 11 bankruptcy, or this is the buying opportunity of a lifetime for a massive rebound. The expectation is that the price has bottomed out simply because it cannot go much lower without disappearing. However, the reality is far more complex and, frankly, more dangerous for the uninitiated capital seeking a home. The reality is that while the share price has collapsed, the company has fundamentally altered its capital structure in a way that makes the stock price deceptive. Through a massive debt restructuring effort earlier this year, they managed to wipe out a significant portion of their billion-dollar debt load, which sounds like fantastic news, but the cost was a severe dilution of equity. So while you see a stock at $1, the market cap is still sitting around $450 million. You are not buying a dead asset for pennies. You are buying a shrinking business that is still valued at nearly $500 million, despite losing over $100 million in the last quarter alone. That is the tension between the optical illusion of a cheap stock and the fundamental weight of a distressed business model. To understand why we are here, we have to look at the immediate past. The third quarter earnings report for 2025 dropped recently, and it was a harsh wake-up call for anyone holding out hope for a swift recovery. Revenue came in at $70.2 million, which is a 13% decline compared to the same time last year. Now, in the world of high-growth stocks, think back to the early days of Tesla stock or the current dominance of NVIDIA stock. Revenue declines of this magnitude are usually the death knell for the growth narrative. But for Beyond Meat, the problem is not just that people are buying less, it's that the cost of running the business is not shrinking fast enough to match the drop in sales. The company reported a net loss of roughly $110 million for the quarter. To put that in perspective, for every dollar of fake meat they sold, they lost about $1.50. A large chunk of this loss came from non-cash impairment charges, roughly $80 million worth, linked to write-downs of long-lived assets and the suspension of operations in China. That China detail is critical. For years, the expansion into the Chinese market was touted as the massive catalyst that would propel the company to new heights. The narrative was that the massive population and changing dietary habits in Asia would provide an endless runway for growth. The reality we face in late 2025 is that they are effectively pulling the plug, taking the loss and retreating to focus on the core markets, which are also shrinking. This retreat signals a significant failure in the global strategy. It is a contraction, not an expansion. Now, let's talk about the trading environment. If you are sitting at home managing your own funds, perhaps using Fidelity Investments or checking your balance on the Robinhood app, you might see this volatility and feel tempted. The short interest in Beyond Meat remains incredibly high. It is one of the most shorted stocks on the market, which always keeps the door open for a squeeze. Retail traders often gather on forums discussing how to squeeze the shorts, hoping for a violent upside move. We have seen this play out with other distressed assets. However, you need to be very careful. Professional traders using platforms like Interactive Brokers are paying close attention to the borrow fees, which are high, but they are betting against the company for a reason. The fundamentals are eroding. If you are looking for investment help or utilizing Schwab intelligent portfolios, you will likely find that automated algorithms and conservative wealth managers have completely exited this position long ago. Fidelity Wealth Management advisors would likely categorize this as a highly speculative play, suitable only for money you can afford to incinerate. The difference between self-investing on a mobile app and professional institutional allocation is often risk management. Institutions see a company with negative gross margins in some quarters, massive legal liabilities, including that recent $39 million trademark verdict, and they run the other way. Let's pause on that legal verdict. $39 million might not sound like a company killer for a giant like Apple, but for Beyond Meat, which finished the quarter with roughly $117 million in cash and cash equivalents, a $39 million judgment is a massive blow. That is nearly a third of their liquidity, potentially tied up or gone, depending on how the appeals process plays out. This adds a layer of existential risk that goes beyond just selling burgers. I want to pivot a moment to the actual business. What are they selling? The company produces plant-based meat substitutes, burgers, sausages, ground beef, primarily made from pea protein. The initial excitement in 2019 was palpable. We all remember the lines at fast food joints and the stock soaring to $239. The belief was that environmental concerns and health consciousness would drive a wholesale shift away from animal protein. The common ground we all shared was the idea that this was the future of food. But here's where the contrarian reality hit hard: inflation and taste. As inflation gripped the global economy over the last 3 years, the premium price tag of Beyond Meat became a hurdle that consumers could not jump. When a pound of real ground beef costs significantly less than the plant-based alternative, the flexitarian consumer, the person who eats meat but is willing to switch occasionally, switches back to the cheaper option. Furthermore, the health halo has slipped. Questions about the heavy processing and long ingredient lists have made some health-conscious consumers skeptical. It's not just a vegetable patty, it's a highly engineered food product. This shift in consumer perception is harder to fix than a balance sheet. You can restructure debt, as they have done, but you can't easily restructure a brand's reputation once the novelty wears off. In the most recent quarter, U.S. retail revenue dropped over 18%. U.S. food service revenue dropped 27%. These are the core pillars of the business. The narrative that restaurants will save them or retail adoption is growing is currently being contradicted by the hard data. The company is guiding for fourth quarter revenue to be between $60 and $65 million. If you do the math, that annualizes to a run rate of roughly $250 million a year. At its peak, this company was valued at over $14 billion. The compression in value is staggering. However, we must look at the other side of the trade to be thorough. Is there a bull case? The CEO, Ethan Brown, has been aggressive about right-sizing the company. The massive reduction in debt from over $1 billion to around $250 million does give them breathing room. They are not suffocating under interest payments in the same way they were a year ago. If, and this is a massive if, they can stabilize revenue at this lower level and cut costs furiously enough to reach positive cash flow, the company could survive as a smaller niche player. There is a scenario where Beyond Meat becomes a sustainable, albeit much smaller, specialty food company rather than a global disruptor. If the stock is priced for bankruptcy and they avoid bankruptcy, the equity could re-rate higher. This is the gamble that retail investors on SoFi Invest or Robinhood Investments are taking when they buy at these lows. They are betting on survival, not dominance. Let's think about the broader context of online investing. When you look at investing sites and read the analysis, it's easy to get caught up in the technicals, the support levels, the moving averages, the RSI. But for a company like this, macroeconomics drives the bus. We need food inflation to come down significantly for premium alternatives to become attractive again. We need a shift in consumer sentiment that stops viewing processed plant-based meat as fake and starts viewing it as necessary again. Until those macro shifts happen, the company is swimming upstream. For those of you engaging in individual brokerage accounts, managing your own risk is paramount. You might look at Fidelity ETFs or Fidelity mutual funds to see if they hold BYND. Most broad market funds will hold a tiny sliver simply by virtue of it being in the index until it gets kicked out. But active managers have largely capitulated. The smart money has left the building, leaving the volatility to the high-frequency traders and the hopeful retail crowd. The competition is also fierce. It's not just beyond